I'm fine that there's not a lot of people. I mean, it's like a random time, but because we're streaming, it's all good. Like, it's gonna get into the database, and we're still gonna get that exposure. Okay, today we're going over the next episode. This is January 9. We've already done 4 episodes, like excluding this one. So 1, 2, 3, 4, and we're going into the next one. We're gonna slowly work our way through the entire 2023. I mean, as long as we keep growing and people still want to see this. We're just kind of watching ICT, looking at what he says, the concepts that he marks out, showing you guys that exact price action in the most recent times, like our charts. Like, I'm going to be showing you guys an example of the new week opening gap, because he actually highlighted that later in this episode. Let's see, where was that? Right here. Also, could you guys hear my screen?
Trades down one single pass, comes up, stops there, goes lower. So it left.
Okay, let's begin. I mean, I hope you guys could hear ICT.
On this candle here, I'm watching that. That is a potential order block that I like. We'll see if it wants to get down to that and show some kind of respect there. But if it doesn't, this one here, mean threshold of that candle right there is the last line in the sand. If it fails to hold price higher, then we're going to most likely attack the sell side here. It would need to get back above half of this wick on a closing basis for me to feel bullish again. Okay, so it makes it real short and sweet. And we're going to drop down to the hourly. Right here's hourly, even the S&P. And here's our daily volume imbalance. And we have a fair value gap right there. So we have institutional order flow entry drill right there, going down just a little bit into the gap and rallying up to our levels that I shared on Twitter this morning. We have a gap opening here. So it's a new week gap opening. That we'll look at that in lower time frames. And also notice how we found some support right at the top of that old daily volume imbalance. Pretty cool, isn't it?
Okay, just to go over the concepts that he just outlined right now, we have a fair value gap. So for those of you that don't know what a fair value gap is, it's like the range between 3 candles. Usually if there's a big bullish candle like this or a big bearish candle like this, it's in between 3 candle ranges that you'll get a gap in between it. The next thing that he outlines is I'm not sure what this orange one is. It's a daily concept or confluence. And then there's this gap right here. So this gap right here that I'm going over right now with my crosshair, it's a literal gap. It's not a fair value gap. It's a literal gap. It's called like a volume void. He calls it the new week opening gap. There is no liquidity here. It gapped up. This is typically a confluence that tends to be like treated back and forth over and over again throughout the week. Maybe even in a few weeks. Like, it takes a few weeks to actually close up the range. So when this happens, what market tends to do is close over it with a bearish candle and then a bullish candle on every time frame. That balances the price range. Right now there's no liquidity. So what market wants to do is come into it and make sure that there's liquidity in this gap. Make sure that there's no like volume void. So to balance the price range, it needs to close over it with a bearish leg and then a bullish leg. Then it will no longer reference that range. And you can see this gap like almost on every time frame. So on the daily, you can see that from this bearish candle close to this open. So even on the daily, it has to close. So even on the 1 hour, if it closes over it like down and up, as I just mentioned, it's not going to be a balanced price range until it closes over it on the daily time frame as well. So you can reference it over and over again. So first thing we saw here, pull back twice from it, and then we probably ran up from here. There you see, we closed into it, or we ran into it, but came back up and closed it. This shows you signs of bullishness. Like from it, it's already respecting this range. Comes up from it, and then closes over it. That's the first leg on the 1 hour. Now it's likely to pull up and close above it, just like that. Look, it just did the same thing twice. It ran into it, closed at the midpoint, returned from it, ran into it, closed at the midpoint, returned from it, and then closed over it. So now this is a balanced price range on the 1 hour time frame. And you are most likely not going to actually use this range anymore. But what we did use this last week with VIP is this trade right here that I sent out on the 1 hour. We were looking at this 1 hour IFEG. We were previously incorrect because we expected it from the 30 minute, but we ended up using the 1 hour instead. I mean, 1 hour is obviously higher than the 30 minute. So we ended up using this IFEG after this range became a balanced price range, right? Like I said, it has to close over it with a bearish leg and then a bullish leg. Now that this is a balanced price range, we can expect a trade from it. All we really need to target is like these highs right here. We just trade from this range. Wait for that pullback. Get in this trade. I already know what's going to happen because we've traded this range and we get that little pullback. That's all we needed right there. This is a 60 pip range. Boom, sweeps the highs. So that's just an example of how I used the new week opening gap this week. But let's hear what he has to say about it.
This is exactly what you would expect to see from support and resistance, but it just simply never works that good when you try to draw highs and lows and diagonal support and resistance that doesn't exist. I know some of you get mad when I say that, but the algorithm has no respect for that kind of thing. Okay, but let's drop into, let's actually go back a little bit. I want to show you where I anchored these levels right there. Okay, so this area right here is where I have the high of 39.69 and a quarter and the low of 39.59 and a half. This candle's high. You're looking at that value right there. That candle's high, 39.50 and a half, and this candle's low, 39.69 and a quarter, which is this level here. Watch. That candle.
Yeah, for those of you that don't know, this on the top of your chart, OHLC, that shows you the open, the high, the low, and the close of every single candle, depending on wherever you put your crosshair on it. I have it removed on my charts right now, but it's actually a really good tool to understand it. I just kind of understand the concept, and I don't actually need to look at it. Let's see where this is. Open, low, close, canvas. It's somewhere here. Yeah, chart values, that's what it's called. Okay, see this OHLC. So if I drag my crosshair onto this bullish wick right here, or bullish candle, it'll show me the high of it, which is, let's see, 2415.8. So that means the very high of this candle, look at the right side, 2415.8. There it is. The low, the open, which is like the start of the candle, not the wick. It's the start of the actual candle. That is the open, and then the close is the top of the actual candle. So you have these open, low, high, low, close values.
Candle's low, 39.69 and a quarter. And that's what you see those levels here. So what's happened was the market trades down, comes back up, trades down one single pass, comes up, stops there, goes lower. So it left an inefficiency here. So that's a fair value gap. What kind of fair value gap is that? A SIBI. Sell side imbalance, buy side inefficiency. Okay, so it's going to want to see a move back up into it. And we see that actually occur today. Beautiful. Look at the bodies of the candles respecting the high of that fair value gap. Isn't that beautiful? Like that, to me, never grows old. It's such a beautiful sight to see. And when you see something perform as you would expect it to, and it's been codified the same way for years, it just keeps going over and over and over again. The same logic is always unfolding. And you keep worrying about whether it's going to fail or stop working. Keep trading it until it stops working. Let's do it that way. Okay? For all of you have chain came to now. Equilibrium's here. So below equilibrium for a discount.
First thing he talked about over here was the 1 hour candle that he outlined with the open, high, low, close. He was just showing you guys the high of the fair value gap and then the low of it. But basically, he like this precision where it closes at the top and returns from it. A lot of people ask me, like, where do I actually take my trade from the fair value gap? Do I trade from the midpoint? Do I wait for a wick to fill it and then close below it? Do I trade from below it? Do I wait for the IFEG and trade above it? But it's different every single time because the market has a unique characteristic to do whatever it wants. Every week is a unique price range. You just have to know to adapt. If your bias is bearish and you're aiming for the discount, as he's outlining right here, from the bottom to the top, he has the 0.5. If you take a fib like this, 1, 0.5, and 0, that should be my fib settings. That's the only fib that I actually use. Like, I know of the optimal trade entry, but this is the only thing you need on your fib. The 0, 0.5, and 1. This will just show you the premium and the discount range. That's all you need. So what he's showing you right now is the premium and the discount. The discount is below the 0.5, and that's what it's drawing to. So what I'm saying is if your narrative is aiming for the discount, if you're bearish, then even if it closes above it right here, you might still get the pullback below it and being able to use that fair value gap to go lower. But what happened here is that the candles perfectly respected the high of this fair value gap and returned from it. It closed, even though it wicked above it, it came, closed below it, the actual high of it, and ran back lower. So that was just insanely precise. That's a good way to get your entry. If you see the candles respecting it, the next one open and give you that sell-off.
Yeah, we have this here.
So the next thing, in the discount, so below the 0.5, there's a fair value gap. So if you're bullish and you have a range like this, you want to trade from the fair value gaps in the discount. Let's find a better example from the past. Okay. So just looking at this huge price leg up, this would probably look better on the higher time frame. So this huge price leg up just from here to here. If we mark out the high and the low of this price leg, then your first entry would be from a fair value gap in the discount if you're bullish. And the first one that catches my attention over here is this one on the left hand side. So we have this right here. So say you're bullish. We're ignoring that this huge leg down right here. We're going to pretend like this never happened. We're going to go back in time. And we're going to say, okay, we're insanely bullish. We've been running up on gold for the last month. We're going to probably keep running up. There's some news, like Trump almost got shot. There's a lot of fundamental news. We're going to buy from the new week opening gap plus this fair value gap. So because we're bullish, we wait for it to trade into the first discount fair value gap. And now we can actually look for our buy. So the only reason that we know that this fair value gap is likely to be valid is because it's in the discount. And you could have taken your trade and got the pips that you wanted. Look, it fills it, runs back up, closes at the midpoint. It doesn't close below it, so that doesn't create an IFEG. And you get your buy side. Like that's already a huge pip range from 2390 to 2320. That's 300 pips. Set to mute him real quick. So that's kind of how you use the PD array, premium discount range. And same thing for selling. If you're bearish, you're going to take your Fibonacci from the high to the low of like a leg like this. And you're going to look for sells from the premium if you're selling. So the first like fair value gap that we'd be able to use is this one, the high of this fair value gap. Because it's in the premium already. It only ran from the low of it, but typically if you're selling, then you'd be looking for a trade from one of these two fair value gaps, the upper bound of this fair value gap, factoring in for this fair value gap, because there is no fair value gaps higher. These are the only two. So if I was to take a trade from this fair value gap, then I would simply factor for this one and put my stop loss above it, because it exists. even if you think it's going to melt from there, it still has the chance of trading to the fair value gap because it exists. It's still there. It's an inefficiency. Price is likely to reference inefficiencies at one time or another. So you always want to factor for it. If you're like, okay, I want to get in right here, but I can't drag my stop loss over here because this is too much loss, then lower your lot size. You can simply lower your lot size, which will allow you to put a higher stop loss, risking the same amount. You can risk 1% with 10 pips, or you can risk 1% with 50 pips. Now let's dive back into this.
Okay, so if we get below this, man, look at all the liquidity below that low, this low, this low. There's a ton of money just sitting right there at 38.18 and to 38 even. Like, enormous amount of liquidity down here. So I'm watching this here with the expectation that if this gives way and it goes down below, maybe comes back up, acts as resistance, it doesn't need to do that. But if it did something like that, then I would be looking for a nice run down here. But I'm studying it, watching, see what we get from here. But let's flesh this out a little bit more. We have a little bit of a fair value gap in here. And we trade down to that. You'll see that when we drop down to 15-minute time frame, which we're going to do right now. And this is the level and levels that I showed you today in Twitter. And if you're not a subscriber to my Twitter, it's that one each month of my week. So if I'm tweeting too much or I'm too busy, orange shaded area, that's what we were looking.
Okay, the daily volume imbalance, that just means it's a fair value gap. It's a daily fair value gap or a gap. It's just, actually imbalance is a gap, so it's going to be something like this. I don't think he'd say imbalance for a fair value gap. He would say inefficiency.
For as an upside objective last week, and it got to it, and then we found some support there.
Let's see.
Okay, and then the market rallies. Trade S&P.
Oh, okay, it's the thing that you went over in the start of the video. It's the gap. Yeah, it's not a fair value gap. It's a literal gap. Like, it's like a daily volume imbalance. So it gapped from one day close to the next day open. Okay, that makes sense.
Here in ES and the US, back off of it.
I want you guys to also go take a look at the Instagram page today. One of the questions that I answered, I did something similar where somebody said I was trying to find a setup from a higher time frame. Like, I was using the daily inefficiency, and I was going down on the 1 hour and trying to find an entry. And I took a screenshot of the 5-minute with kind of outlined like this: the breaker block, the IFEG, the fair value gap. There was multiple legs of distribution that you could have taken a trade from. That's because this guy's looking for a trade on the 1 hour. But the 1 hour also excludes the fact that there's kill zones and sessions. You have to go lower time frame than that to actually trade the session. You have to go down to the 1 minute to use macros. You got to go down lower than the 30 minute to actually use the session. Like, when it trades into a fair value gap on the 5 minute, runs up, creates a 1 minute breaker. Like, you gotta acknowledge all of that and puzzle it together with that daily imbalance. It's not just about like fair value gaps. It's also about the time. You have to use the sessions, the macros, all of that stuff.
I'm highlighting this because I thought I saw something in the US 500, but was referring to it as if it were this chart here, ES for S&P 500 futures. The prices are going to be slightly different, okay, if you're comparing ES and the US 500 chart. Now look at the US 500 chart before I close this one out. But the market reversed in here, and I said, okay, we're back inside the breaker. I said, return your attention back to 39.50 up here when we were in here. Then go back and look at the tweets, and you'll see that's the case. It rallies up. And then we took out this short-term high, and I said, okay, when you get to your fair value gap, which we'll see right in here when we drop into it, 1 minute chart, let's go right into that because this is already getting long-winded. It's okay, ICT. We like the long ones. And other folks, you're making videos too long. We could have done this in 5 minutes. You could have done this video in 30 seconds, ICT. I'd love to see you do it. Do it all live, mark it up like this, and then come back and explain it in 30 seconds where it makes sense, where it's useful, not just, this is what it did. All right, so this is your 1 minute chart. So we had sell side below here, wick down through it, came back above, came back down to the order block here on the, I believe that was the 8 o'clock candle. Let's see. Yeah, 8 o'clock candle. So we found some support there, watch and consolidating. And I mentioned on Twitter that we would likely rally higher and reach up into this short-term high here. And then we got 12 handles of a run, 10 to 12 handles. That's okay. You would say right now, this is a partial. You would mark that as a screenshot that we can see what it looks like. So from here to here, that's a bread and butter setup. Then we came back down. And this is the range I told you to drag out, crossover your 1 and 5 minute charts. That's your bullish breaker. Let's mark it.
Okay, so my job in these live streams is to show you guys concepts that you may not already be aware of. So what he's referencing is breaker. He references 2 different breakers. So if you look at it, like just from me showing you right now, I'm about to hop into my charts. There's a low, there's a high, lower low, and higher high. There's a low, there's a high, lower low, and a higher high. Basically, once this lower low is created, and you're expecting buy side from, say, this daily inefficiency. So we're expecting buy side from here. So once we are expecting the buy side, we can already predict that it's likely to trade higher. Right? So there's this lower low, higher high. So you want to see it run from this breaker. Same here. Lower low, higher high. There's also this fair value gap that he uses, plus the breaker. So let me go show you in the charts. This is what the pattern actually looks like. Breaker block is the only one that you can actually see as like a pattern. You have this lower low. See, so there's a low, lower low. Basically, you can think of the lower low as a liquidity sweep. So the breaker block is like a liquidity sweep, and then you get a higher high. Higher high, and then you expect the trade when it comes back into it, and a run from it. So just like this. You'll see that the first one that he outlined didn't actually run from it. So look at this. The first one that he shows over here, it's supposed to be a lower low, higher high, and you're supposed to get that move from it. But it dug deeper into this higher time frame fair value gap. So if your breaker block isn't like paired with some sort of other confluence, like a fair value gap, so this one right here, there's a fair value gap exactly inside of the breaker block range. So he was able to probably take a trade directly from here. Right? So what you want to add to it, what I add to my breaker block setup is a IFEG. So if we go look in the charts, what do we have? Where would the breaker be on the daily here? There it is. So it may not be as obvious to you guys right away being able to see this, but there's a low, higher high, lower low, right? It runs below this candle right here, lower low. Then it comes back up, digs into it, and runs down lower from it. So take a look at this. Boom. That's the breaker block. Even though it wicks above it, it ends up coming down below it and melting lower. So let's look at a lower time frame one because it's easier to spot those. We'll just dive into price leg. I don't want to look at this week. It wasn't as precise. Right here. Okay. So if we're bearish here from this fair value, or this breaker block actually, we have a higher high, or a high. We have a higher high now, and now we're expecting the lower low. So when you're expecting the lower low, you take the lowest bearish candle like this and you drag it out, and that's going to be your bearish breaker. So now you just slowly start to see price move down just as you anticipated. It's moving down. Once it breaks below that breaker block range, I mean, this is just consolidating. That's crazy. There you go. Once it breaks below that breaker block range, you'll see that price references. So you actually want to use the wicks too. I didn't outline that correctly. Basically, what I'm looking at is this bearish candle right here. We have a high right here, higher high, and a lower low. It's kind of confusing because I was just looking at the bullish one, but the bearish one is a higher high, lower low. Basically, it's a liquidity sweep and a run down below the last candle. Right? We finally closed below it and we tapped into this breaker. That's when we'd get into our sell and aim for more like a deeper sell side. There you go. See how the candles are all respecting this midpoint. We're closing below it even though we're wicking above. And that's kind of the one ICT concept that people call a support and resistance. But I mean, you know, let people say whatever they want. And that's how you would trade the breaker block. So now say we're bullish. We have a low. I'm not sure if this actually ran up, but we have a low. We have low swept right here. We have a high. So if we get that higher high, we can use this bullish breaker range right here from this highest up close candle. Let's wait for it to close above. Boom. Coming back into it. And yeah, we didn't get that range. It instead came down to reference this fair value gap right here. I think that was this week's range. July 23. Yeah, that was this week. There you go. 1 hour fair value gap. It's kind of like the same one as the example that he just showed us earlier. Let's get rid of this. You see how it wicks below, but the candles actually come up and try to respect it? It's exactly the same as this range over here. You see that? Candles came up. Boom. But the candles closed above. Same thing. 1 hour fair value gap. Candles wicked below it, but the candles closed just around the bottom of it, and then we ran from that.
Yeah.
So try to dive into your charts every time you see something similar in your chart. Like this is E-mini S&P, yet I just saw the same thing that he showed us on E-mini S&P in the gold chart. Right? It's not limited to any chart or market. It's something that you can see in every chart, and the way that you learn, like if you want to actually learn in a fast amount of time, then go into your charts and mark out everything that he shows you. If you see something like a breaker block, go into your charts and see how often market respects a breaker block. You obviously have to pair it with bias, but this is how you learn. You go mark it in your charts, and then you try to trade it the next day.
Do it all live, mark it up like this, and then come back and explain it in 30 seconds where it makes sense. Where it's useful, not just, this is what it did. All right, so this is your 1 minute chart. So we had sell side below here, wick down. Okay, I want to be above the relative equal highs, and you can see that here at 39.56.5. So one full handle above.
Okay, let's look at his executions. I don't know if he had any over here where he's covering it up, but you can see that he took a trade from this fair value gap, which was also inside of this breaker. That was his first entry. His exit came after the high was swept, after it entered this fair value gap. His next exit, after it consolidated a little bit, created some highs and swept it again. And then he exited when it looks like it was going to leave this fair value gap range. Because remember, this is the 1 hour fair value gap that he was showing us. So he likely thought that it was going to leave the range and close this position.
This level here. And then I put a stop loss in right below the high end of that fair value gap because I didn't want to be babysitting it on my phone. I couldn't keep track of it because I was going to be away from the screens. and I just put the stop loss there. Told everybody, I said it's either going to hit my limit, which I had sitting at 39.59 even, or stop me out. And it stopped me out. And then right at my stop, which I made public, isn't that interesting? It rallies all the way up to the high end at 39.69 and a quarter, and just a little bit above it. Relative equal highs are formed. Then it breaks down, shift in market structure, breaks lower, fair value gap, shift in market structure, rallies up, sells off. Half the imbalance from here to here, that's consequent encroachment, is accumulating short positions. Failure to get there, that's a sell. Right there, that candle right there, that's a sell. Boom. And it just keeps on melting. Consolidation going into the latter portions of the late afternoon, and then bang. Just a beautiful meltdown. And I realize this is still up here. Apologize. And there we are. Just a wonderful, wonderful day. Technically, just beautiful. And all of this here is a market maker sell model. So we have consolidation. What's below the consolidation? Sell side liquidity. We rally up, buying inside of a breaker. See, you all think it's just, you got to wait for it to come back up and then buy it right there. Yeah, that's the infantile approach to doing it. But if you know direction, don't buy it.
Yeah, that's true. If you, like I was showing you guys, it's the lower low, higher high, and then it comes back into it, and that's where people take the buy. That's how the concept works. He always says that you can actually trade from before that even happens. Like even from this liquidity sweep, you can already expect that this breaker block is going to happen. You can trade it from the IFVG. And when he was talking about the market maker model, usually market maker models have a leg of distribution or consolidation. It's actually accumulation when it's running towards its price. So it accumulates price, typically sweeps some sort of sell side, then runs to its target, and then you get the legs of distribution. We got one recently in Euro USD, same thing in, let's take a look at Euro USD. 4-hour chart. Daily. Okay, what did it run into? I guess we can just look at this daily fair value gap here on the lower time frame. Okay, so we start from the daily, right? I'm on the daily chart right now. Now I hopped into the lower time frame. Now I go even lower. And I'm on the 1 hour. We typically would trade from like starting to find setups on the 1 hour and diving into the lower time frame to actually scalp into it. So typically what a market maker model would consist of is a higher time frame target. So a daily draw on liquidity, which means that we expect it to run into this daily fair value gap, right? We want to see it run into it. In order for price to run into it, it has to first build up orders. So what I can already see on this 30-minute chart is this fair value gap. We're consolidating, right? Look at this consolidation. This is going to be the first leg of the accumulation. So right here, we have accumulation, which means it's just consolidating, building up orders. Then we finally get manipulation. We sweep highs, we sweep lows, creating a fair value gap after we run up here. This fair value gap then gets referenced. So first we have this first leg right here of accumulation because it manipulates both sides, building up orders. Right? Then we get this move and we come back and get a second leg of that accumulation phase. We build up all those orders here in this fair value gap and we run to the target. That's your market maker like sell model, because then you start selling off after this. So after it runs down from this target, you get what? More fair value gaps. Boom. You get the fair value gap. Consolidates within the fair value gap. Body is respecting it. Let me drag this more accurately. Okay. Body staying within the fair value gap, run from it. Like, I mean, this isn't your perfect market maker model, but it's kind of how it works. It all revolves around the higher time frame. It has to run into this higher time frame. I'm going to see if I could find another example that's a little more clear for you guys. Let's look at this one. No, that's too far. I'm not going to get a lower time frame for that. Midpoint. I'm going to look at a different chart. No, you don't only use the body of the candle for the breaker. You use the wick as well. Okay, I'm just going to find this on gold. I don't honestly remember what the last market maker model that I used was. Probably this one right here. We have a daily premium for value gap above some highs. So look, we have a high right here, and the midpoint was previously not traded to. Okay, so going into this week right here, what we were aiming for is the midpoint to be traded to, because we have a high right here, which is a draw on liquidity. We need this high swept, and then we have this, let me draw that perfectly. We have this high right here, and then we have this fair value gap that was previously not swept in the midpoint in premium. So a market maker model, market maker buy model, would be finding the legs of accumulation that lead us into this. So, I mean, we already have on the daily chart this order block right here. Boom. You see how price is consolidating within it? 2 days of consolidation. Third day runs on the lows. And then we get expansion. We run into it for the first time, but we still miss the midpoint. So going on the lower time frame here, I mean, you see another market maker model right here. Accumulation, distribution, accumulation phase 2, distribution into the target. Then you get some sort of distribution phase, right? We have the first fair value gap right here. Boom, that's the first phase of distribution. Fair value gap, runs into the midpoint, runs from it. That's your first market maker sell model after it ran into the market maker buy model target. Then you would expect the second phase of manipulation running lower. But instead, we ran to the midpoint. But this is also a market maker model. It would have been the pitch perfect market maker sell model if it ran to the lows here. After this first phase, if this consolidated and then ran to the lows, that would have been a market maker sell model, right? Sweeping this liquidity. This buildup of lows is also going to be a draw on liquidity for the future, because we have yet to run on these lows. These as well. Let's dive back into ICT.
You know the next draw on liquidity, which was going to be this level up here, which I shared a tweet and saying this is where we would be. Then we have a fair value gap inside of a larger 5-minute breaker. It's obvious. It wants to go higher. So you want to accumulate like smart money does and buy it while it's inside the breaker. And then when it expands, you know you're on side. You don't need to wait for the breakout like retail. I don't do that. I do not trade like that. I know where it's going to break out before it's going to break out. And then I can trade inside that consolidation right in here. And keying up on what? Let me take that off. You can see that fair value gap right there. Let me take this off. You can see that little imbalance.
Okay, I'm just going to skip through the rest of this video because I'm kind of done already. Okay, new week opening gap, which is something that he referenced, right? It ran up into this 1 hour fair value gap, which also is sold off from. This is US 500. This is the Forex pair of the futures version that he was showing us. Look, on the futures, it was a lot more perfect. See how on the 1 hour it respected the high. On the US 500 Forex pair, it's less accurate. I mean, that's to be expected. Forex pairs are a little, there's more room, so you need to always add more room for it to potentially draw higher than the futures pair would. Same thing though. References the new week opening gap, runs to the fair value gap, fills it completely, runs from it. So you get a market maker sell model. Accumulation, you buy to this higher time frame target, and then you sell from it. And then he probably just talks about Paladin here. Alright, that's going to be all for today's stream. I'm going to prepare some price action to back test for you guys, because I don't want to just nail it and try to find some things. We can look at breaker blocks right now though, so let's actually dive into lower time frame chart. So I'm going to show you guys how to backtest right now. First thing that you want to look for is the higher time frame narrative. So mark out potential inefficiencies or voids that market will trade to. So weekly chart, we have this one right here. Say volume void. I'm just going to mark it out so I know what it is. Volume void. And then you dive into the lower time frame. On the lower time frame, we have all these fair value gaps. We have this fair value gap. We have this fair value gap. Boom. Boom. So just going into this, I marked out some of the daily confluences. The second thing is that we swept all-time highs, right? This day, right here. We swept all-time highs. Now we're just looking for some sort of a pullback. Boom. So this day, let's hop into this bearish day right here and see how it trades around this fair value gap. Boom. 1 hour chart. So we're getting some sell side after sweeping all-time highs. Not surprising. Boom. So what do we have here? Just going into price action here. If I was trading this range that week, I would find this liquidity. Like, it barely missed it. But after a big move like this, there's no way that it wouldn't run on this low. So we're obviously bearish, right? Now we want to find some sort of entry model that will take us down here. We have this fair value gap that we're consolidating in. So that's already enough of a confluence to push us lower, right? So now we just go on a lower time frame and find that entry. One of the entry models that I use is macros. So let's check what time this is in. 1250 to 1310. That's the macro. 1250 to 1310. So within the macro, we want to see some sort of liquidity get swept. Let's see if I can go on a lower time frame. Boom. Okay, so we're bearish, right? We're consolidating within this fair value gap. Now we're inside of a macro, and we want these lows to get swept. So just like going from the higher time frame to the lower time frame and adding my entry model, I can now create a setup for myself that will allow me to trade to this fair value gap here, to this target. But I need to see some sort of a confirmation. Okay, I didn't get a trade during that macro, but the macro closed, so we're not going to look at that anymore. It still looks like it wants to run lower. And what do we have here? We have a high. We have a higher high now. And if we know that it's going to run down to this fair value gap, this is our draw on liquidity. What can we do? We can trade a breaker block, right? We're expecting this to be a breaker block. We just swept this high right here. And we're on the 1 minute time frame. What do we want? We want an entry from one of these bullish fair value gaps that was disrespected, creating a IFVG. So if we get a pullback into this one, or we close below this one and get a pullback into it, then we can take a trade. Boom. We got a pullback into this fair value gap. We know that this is likely going to be a breaker block. So we're going to take a sell from here. Stop loss just above the highs. TP, boom. That's enough of an entry model. Liquidity, disrespected, bullish for value gap. Let's see if we run on the lows from here. I mean, it wasn't picture perfect from this IFEG, but still, because our stop loss was protected, we might still get the sell side from this breaker block. Boom. Market is respecting the breaker block. All the candles are staying within it. I mean, it's consolidating right now. It's not the best time to be trading, but you can see it's still working its way. I kind of want to see what happens if it just runs in it. Okay, London session starts and it just runs straight to it. And if we look at price action after, we have this range as well. We have the fair value gaps in this range. Remember the premium and discount. So if we take it from the high to the low of this range right here prior to London session, you can see that we have the first discount, premium fair value gap, and then we have this one right above it. You can see that market was first respecting this one, ran into the premium one right here, and melted off from there. I guess the only concept that we were lacking here was time, right? This was right before London session started, and before session start, you might get some consolidation and get chopped out. So it's always best to wait right for when the session is starting so that you can get the move as soon as it happens. Okay, the next thing that I wanted to pay attention to is what actually happens after it runs into this fair value gap, right? Because this is a daily fair value gap. Boom, we close below it. So just on the 1 hour time frame, it's London session. We swept all-time highs, and now we're getting this big bearish move. What do we want to see? A pullback somewhere into the fair value gap inside of this lower time frame. We might get some consolidation first. Boom. Now we run into it, sweep some liquidity, and we have this fair value gap right here. Kind of want to get these executions out of the way, but there's a fair value gap right here. I'm going to just mark it out for you guys. Consolidation. After closing below it, we have this fair value gap. We just tapped into it. I'm going to take a sell from there. Why? Even though we're on the lower time frame, we closed below it, and it's London session. We want to see rapid liquidity towards, rapid movement towards liquidity. So we're just going to take this entry model, aiming towards sell side. You can see markets respecting the midpoint and this for value gap, but it looks like we're going to take an L here. Okay. Let's see what else we can get. We're going to look for an entry during the 250 to 310 silver bullet. This is the London silver bullet. So now that we actually got some consolidation within this daily range, we're still bearish because we closed below it. So let's just look for an entry inside of this macro. Okay, we swept buy side. Remember, macros are sell side to buy side. So if we sweep buy side first and we're bearish, we're going to look for a sell targeting the sell side. Right? And then just as I've been telling people to use a 20 pip stop loss. 21.69 to 23.69. That's 20 pips. Our target's more than that anyways. We have these consolidated equal lows. We can likely draw towards those. And boom. So we were still bearish because the market closed below this fair value gap, and we're drawing towards sell side rapidly after sweeping all-time highs. So even if you take a loss, I've been telling you guys on psychology, if you take a loss, you don't just end your trading day there and beat yourself up about it. Your bias wasn't wrong. You might have just gotten in at the wrong time. And that's why you want to have multiple different options to getting into trades. Like this macro. I didn't get in at a macro here. I got in at a fair value gap, which is valid, right? But it wasn't what market was looking for. It was trying to create a range first to potentially stop out any sellers here. Get out sellers there, scare some more people out, and then actually melt off. Right? We're selling off from this daily range. So we're using the daily range on a lower time frame. Let's go back on the higher time frame and wait for it to trade into the next one. Okay, now it's New York session. We have the next fair value gap here on the daily chart. I don't think we got anything. I actually traded from it in Asia session. So let's go into Asia. Okay, I remember this. In Asia session, we were looking for a sell to this daily fair value gap, and then we also bought from it. So just looking at this daily time frame, scaling down to the lower time frames, we're going to mark out any potential confluences that we can use as entries for Asia session. So the first thing we're going to do is we're going to wait for Asia session to open. Right now it's 8 p.m. Okay. On the lower time frame, Asia already started. We want to see it disrespect some sort of bullish confluence, and then we can use that as our entry. Here we also have a order block right here. If price gives us an entry from this order block, we might end up selling from here. So let's look at the next candle. Okay, it respected that pretty well. We can go on a lower time frame and look for something. So first, on the 30-minute, we respected this candle. Next, what we want to see is a disrespected bullish confluence. So let's wait for a bullish range to happen, and then we want it disrespected. Okay, it's the London session again. We didn't get what we were looking for in Asia session. It just kind of ran from this 30-minute order block, which was valid if we wanted to get in on a higher time frame. Let's keep watching. Even if it trades to this range without us getting a entry, it's fine because we have two potential targets. We have this bearish target, or it could run back up here, right? But we're more likely to aim for this bearish target, which is resting right below this liquidity. Okay, let's wait for it to trade into the range for the first time, and boom, it trades into the range for the first time. You don't want to get too excited after it pulls back and start buying, because it's likely to fill the whole thing. But now that it filled this whole thing, we can probably get a good entry just from here. Let's go on a lower time frame. Boom. We already got a first entry from a fair value gap after it filled it. Let's look for it to tap into this fair value gap, and then we'll catch a nice low 20 pips. Boom. I'm going to get in right here. I'm going to secure my stop loss below this fair value gap, and I'm just going to target it leaving this range. Okay, disrespected this fair value gap, but if it comes back above it, it can still reference the fair value gap. As you can see, it's probably going to run back into it. There you go. We tapped into it again. That's valid to enter again. I mean, we got pretty close to getting stopped out, but we were safe below this fair value gap, right? It's still a potential target. This one was in the premium. This is in the discount. We added some more entry, and boom. We're running slowly out of this fair value gap. It's a lot of consolidation. We didn't get the trade there. But I mean, we did get the liquidity swept here. We had equal highs. That could have been a potential entry. But we were looking for it to leave the daily fair value gap for the first time, which we didn't get. Let's look for another potential entry. It's 11:50 on a Monday right now. Let's look for a entry from the macro. 11:50 to 12:10. Okay, boom. We're inside of a macro. We want to see it to run on either sell side or buy side. But because we're inside of this bullish fair value gap, we obviously want to see it run up above it. That's going to be our first target. So we're not going to be looking for sells after it sweeps these highs. We want to see it sweep lows. There you go. So it created a low inside of this macro and swept it. It still has the potential to sweep this low. So what I would do in this situation is I wouldn't just like stop if it swept this low. I would still be bullish and allow myself to take another entry. Remember, our bias is leaving this range. So we're just going to aim for it to run up through this fair value gap. Boom. Your first partial should be after it leaves the range. After the macro ends. I forgot to take an entry, by the way. Let's see how it respects a fair value gap. Maybe we could get into another entry. Okay. Let's get into an entry here. We're just going to factor for the fair value gaps down here. And we're still going to target that same thing right here. We just want to see it leave the range. And there you go. So even if we didn't get our entry the first time, remember, don't beat yourself up over it. Your bias isn't always incorrect. It was bound to leave the daily range at some point. So it wasn't incorrect to anticipate it to leave the range and take another trade. So how this looks on the daily is something like this. It ran to this daily fair value gap and pulled back from it. So even though we ran lower, look at this. We ran lower. I guess I'm incorrect. But yeah, the first time it usually pulls into a daily range, you get a nice trade from it. So if you just hop into the lower time frame after it pulls into the daily range for the first time, you can get a nice 20 pips for sure. Yeah, I mean, if this is your first time watching it, then I understand you not getting all of ICT. Can you go over IFEG? 8:30 or 9:30 openings. I use 9 a.m. and 10 a.m. like on the dot. 9 a.m. I typically look for a entry in the 8:50 to 9:10 macro because that's the expansion macro of quarterly theory. So I don't use 8:30 or 9:30. I would just look for liquidity from 10 a.m. or 9 a.m. Can I go over IFEG? IFEG is just a disrespected. If you're bullish, you want to see a disrespected bearish fair value gap. So let's see. This is the example that we actually traded. Like we literally traded this one in VIP. And I showed you guys it earlier. I'm trying to drag this. There you go. Okay, see this bearish fair value gap right here? It's going to act like a bearish fair value gap the first time it runs into it. See that? The first time it runs into it and closes in the midpoint, it's going to act like a bearish fair value gap. And it runs on lows. However, if price closes above it like this, and then taps back into it, it's a bullish fair value gap now. That's called an inverse fair value gap. You get into your buy, stop loss below it, you get into your buy, and you just ride it to the highs. Boom. That's what an IFEG is. You use it to support your bias. So if you have an SMT divergence on NQ and ES or Euro USD and GBP, if you have a nice SMT divergence, you use a IFEG as confirmation for your entry. Look at NQ. Were you talking about market maker models when I was looking at those earlier? Better plug this. Okay, I'm gonna actually show you guys, instead of just backtesting a random range, let's go look into the quarterly theory. So quarterly theory is in each New York session, and the trade happens at 9 o'clock. So what I do is I look at New York session. This for me is 6 a.m. And my trade would happen from a 30-minute fair value gap right here. We have a 30-minute fair value gap at 9 a.m. So what I do is I would dive into the range at 9 a.m. Let's go. Boom. first thing I would mark out. So this is the rules to my entries. So if I'm trading the quarterly theory, I'm gonna make a anchor text. QT model. So rules for entry is a 30-minute fair value gap, macro, and 30 pip TP. So for this model, I'm just gonna build a quick little trading system that I'm gonna follow. So first thing we need is a 30-minute fair value gap, which we have right here. 30-minute. And now I'm just on the 5-minute. I'm going to dive in the lower time frame and look for a trade starting from, like, just within the quarterly theory is 90 minutes. So there's from 6 a.m. to 7:30. 7:30 is accumulation. So from 6 a.m. is accumulation. 7:30 is manipulation, which we got this manipulation. And then starting from 9, we get expansion. So first things first, we look for a 30-minute fair value gap. So we want it to trade into a 30-minute fair value gap. So in this case, we want to see it filled. There you go. We got the fill of this 30-minute fair value gap. Let's go on a lower time frame. This was also during the silver bullet. And it's inside of a macro. Look at this. Boom. We're inside of that expansion quarter of the quarterly theory. And we just take our trade like this. We filled the 30-minute fair value gap. We also swept lows. We're going to aim for this liquidity up here. Beautiful. All this liquidity, we want to see it swept. So that's going to be our entry. We're going to secure our stop loss below this fair value gap to account for any wicks. Remember, wicks can happen. Wicks are okay. And we're just going to aim for the buy side. I forgot to set it to be. We're going to aim slightly above this liquidity. Leaves the 30-minute fair value gap. And sweeps the liquidity. So that's our first trade within the quarterly theory. This is like what my model composes of. I just find that 30-minute fair value gap, dive into New York session, go in a lower time frame, find a macro, liquidity target as well. Let's go back even further. Let's go to the next New York session. Okay, we have another New York session here, but there's very little price action to the left of it. Here we have another New York session with price action. 8:30. Okay, first things first, mark out nearby 7:30. Let's let another candle form. 8 o'clock, 8:30. Boom. Okay, we already traded to this fair value gap, so we might not get the buy side one. It's also important to consider the higher time frame narrative, which I didn't look at. I'm not sure what's going to happen on the higher time frame, so we're just going to aim for less pips. We're not going to aim for a large amount of pips if we don't know where it's drawing to on the higher time frame. Next thing is going on the lower time frame, marking out our quarterly theory macros. So we have accumulation from 6 a.m. 6 a.m. we have accumulation. 7:30 we have manipulation. At 9 a.m. we want to see expansion. So we're inside of this 30-minute fair value gap right now. Now we just go on a lower time frame, see what happens from 9 a.m. We're likely to see some sort of expansion here though. Let's see. Okay. Closed above this fair value gap. So you guys wanted an example of an IFEG. I don't know if we're bullish here, but this is an IFEG. So if we are bullish, market is going to respect this IFEG, and we're going to use it. We're also going to account for the fair value gaps here, because we have fair value gaps in this price leg, and we're just going to target the highs here. There you go. It taps into this IFEG. Let's hope that it runs from here. Pull back. We didn't get our first entry. We've also been respecting this 30-minute fair value gap, so let's go back on the 15-minute. I mean, that kind of spoiled what's going to happen. But we ran on sell side. We got sell side. Let's go back into the 5-minute. Okay, so we might have been wrong. Maybe the bias is bearish. So if it's bearish, there's this 30-minute fair value gap. We're still within the 9 o'clock macro. Boom. We tapped into the order block here, right? The high of this bullish candle. Let's get rid of all the unnecessary stuff that's distracting us. This is the order block. So we're just going to use what price is showing us to go for sell side again. Boom. I mean, that was instant. That was kind of crazy. All that we used was this order block right here. Price traded up into the order block. It was still the 9 o'clock macro of the quarterly theory. We had the 30-minute fair value gap that we disrespected here. And price just ran from it towards the sell side. So we just aimed for 20, 30 pips. Boom. Light work. It's also consolidating. This isn't the best price action for a New York. Let's look at one more range and then I'm going to end it. Okay, this is looking good. Let's go bar replay. 8:30. So what do we have here? Right off the bat, you want to mark out your fair value gaps. We have this premium fair value gap that is still not disrespected to this point. So price is still trading around this fair value gap. We want to see this is 8 o'clock. We have one more candle that we can let print. There you go. We have 8:30. Now let's dive in a lower time frame. Mark out our quarterly theory. We have 6 a.m. Should have done this on a higher time frame. 6 a.m. accumulation. 7:30 manipulation. So manipulation didn't happen yet. And then we have 9 o'clock. So manipulation didn't happen to the 6 a.m. accumulation phase. So we can be a little worried about that. Anyways, we're looking for this fair value gap either to be disrespected or to like something to run on it. Let's let price play from 9 o'clock. We tapped into it. So something that I used to do is just scalp right away. So if we were to get a tap like this, I'd just aim for 20 pips from this range. Like this. Target 20 pips from here. 74.6 to 72.6. Just a quick trade. Well, we didn't get that. But we did disrespect this fair value gap. So that's what we were looking for. We ran on all these highs as well. Boom. Even if we run into our session with a loss, right? If the bias is bearish, we swept these highs and we still respect this 30-minute fair value gap, we can run back down. So let's look for some sort of confirmation for it to actually go lower. Let's see if it closes on this bullish fair value gap. Okay, now it actually closed below it. No, it didn't. It didn't close below it. Now it closed below it. But it didn't give us the entry. Ended up running from it. We want to see a little bit of a higher pullback into one of these inefficiencies to sell. Okay, there you go. Tap into the premium, right? So we have the high to the low of this range. Why is this in the way? We have the high to the low of this range. We mark out all the fair value gaps that are in the premium here, right? Right above the 0.5, we have the first fair value gap, which is in the premium. We can take a sell from here. Stop loss above, secure that stop loss. And TP, we want to see it expand from this 30-minute fair value gap. Just as it took out all the highs, we want to see it take out all the lows. So the same for this liquidity here. This could be a pretty big... Oh, that just happened too fast. I don't know if I would have been break even there. That's something that only like live experience will tell you, you know? Whether you would have allowed this trade to run this far without going break even or taking partial. All that experience needs to happen in the live market. So I'm just going to let this range play out and do whatever. Let's go look at another New York session. Previous day. Okay, let's hop into this right here. 850. We did get the manipulation this time on the 6 a.m. consolidation, right? Accumulation here. We got the manipulation on the buy side and the sell side. So now just going into the 9 a.m. Okay, it didn't print the 9 a.m. Perfect. Just going into the 9 a.m. candle, we want to see it trade into a 30-minute fair value gap. We have a 30-minute fair value gap right here. We are likely to just get a nice little pullback from this. You guys see this fair value gap? 8:30 closed right inside of it. So now we'll go on a lower time frame. We're just going to take a nice little buy from 9 a.m. Let's wait for an 8:50 to 9:10. Let's look at a trade from a macro this time. Boom. We're just going to take a buy straight from 9 a.m. 9 a.m. opens. We're going to take a buy from this fair value gap. Target the highs. That was close. We got stopped out. Let's see if we get a pullback though. Typically when it runs into the 30-minute fair value gap, this would just be a wick on the higher time frame. Let's let it play out though. Yeah, my stop loss was just too tight there. So if we go look at the 30-minute, you can see that it was just a wick, right? So the wick took us out, but what 9 a.m. typically does is expands. So we have first the 6 a.m., right? From 6 a.m. there's accumulation. From 7:30 there's manipulation. Manipulation runs into a 30-minute fair value gap. Like I've been seeing this every single time. It runs into this 30-minute fair value gap. And then you can just take a trade from the 9 a.m. Boom. That was beautiful. I mean, even if it wicked me out, like it doesn't matter to me because I was still right. That's the thing about a lot of you guys, you just beat yourself up. And now even going into the PM session of New York, right? We're getting silver bullet soon. What do we have here? Low, lower low, higher high. We might get something from this range as a breaker block. So we would just look at this bullish candle here. Let's see if we get anything. Yeah, there you go. We got that pullback. Let's get a run on these highs. We have the premium fair value gap here. This is going to be our target for silver bullet. Boom. Silver bullet, it's about to hit. Let's go break even this time because, okay, so next we have this IFVG. We don't want to see it disrespect this if we're bullish. It's about to be silver bullet, so let's see what we run on. Boom. We tap into this for 10 a.m. Our stop loss is still safe. There you go. That's beautiful. This is beautiful, guys. This right here is 10 a.m. silver bullet in action, right? We have an IFVG. We ran from this breaker block, right? And let's just look at for it to keep expanding. Well, I mean, we still got out in profit. It ended up respecting this bearish fair value gap. That was still beautiful. We got the breaker block run on these highs. And then we had this IFVG, which also it tapped into and ran higher. That was nice. That's good price action. There you go. I mean, it still ran on the highs from the IFEG. It just wanted to dig in and stop out all the buyers like us. Alright, I'm going to end the session there, but it's kind of fun doing backtesting with you guys. Maybe in the next one we can actually build a solid model to
Hello.
backtest with.
Hello.
Yo, what's up?
Hello.
What's up?
Can you do a favor?
Yeah, what's up?
Can you please explain the QT model again? I have joined late. Can you explain it briefly? I've shown the backtest but not understand the QT model.
Yeah, quarterly theory composed of 4 different sectors. Let me just drag my screen up. So there's 4 sectors in quarterly theory. This is in our free ebook, by the way. Let me see if I have a preview. Okay, I do. Let's go look at it right here. Quarterly
Are
theory.
you doing these sessions daily or in Sunday specially?
Usually days with red folder news. So if you go to Forex Factory, you'll see it. Where did I write down macros? Quarterly theory. I might have removed it from the ebook. Quarterly theory. Oh, it's right here. Okay, there you go. There's 4 different sectors, so you guys can go find it in the ebook right here. The times. 6 a.m. is accumulation. 7:30 manipulation. 9 o'clock distribution, the expansion. This is where you look for an entry. And then 10:30 is continuation or distribution of the expansion. So now going into the chart, you basically mark out the sectors from 6 a.m. You have the accumulation. You want to see it price just move around like this, consolidating until 7:30. 7:30, this 90-minute macro consists of manipulation. Then we have 9 a.m. is where we look for entry. So what we want to see to get the picture perfect quarterly theory is we want to see manipulation sweep both sides of the accumulation. And then for distribution right here, our expansion macro, we would just look for a expansion from the nearest fair value gap on the 30-minute time frame. So we'd look for a 30-minute fair value gap that maybe happened during the 7:30 price leg, and we would just expand from that. That's the basics of quarterly theory. There's also the 10:30, which some people only trade the 10:30 distribution of the move, which is completely valid. That's probably the easiest one to trade. Like after expansion runs on the target, you would just trade the little distribution from here. That's it.
Yes, sir. Thank you.
Yeah, of course. All right, guys. Thanks for hopping in. Have a good
How
night.
often do you go live?
I mean, it's just depending on my schedule. It's pretty late for me right now. It's 1 a.m. But yeah, just whenever I'm free, I'll do a live call. We just
Yes.
watch ICT in our live calls, and we kind of simplify what he's saying and show you guys it in live price action.
Where are you